G'day there guys, my name's Phillip Wong and today I'd like to have a quick look at how we value shares. Now, shares are interesting because they're kind of like a bond, but bonds being debt, usually you have to repay the original amount that was borrowed, i.e. the premium. But when it comes to shares, that original amount that is the value of the share at issue never gets repaid. So you have what is essentially known as a perpetuity. You can have this with bonds as well, where a coupon rate is paid ostensibly forever or until that bond is eventually bought back again. So perpetuities are quite unusual in the real world, although governments do issue them from time to time. But shares, well, they're darn common. So how do we value them? Well, essentially, the value of a share is going to be the present value of the stream of cash flows into the future. So we're going to look at a very simple method of valuing shares by looking at the future value of all the dividends. First off, we're going to assume that all the dividends stay constant forever, which is pretty unrealistic. And in the second case, we're going to have a look at how these dividends might increase forever at a given fixed rate. Also very unrealistic. Now, I recognize that, well, you know what, simplifying assumptions are not too bad because they can be used as a proxy for the real world. And of course, in the real world, there are so many other things to consider. But hey, first year finance, got to start somewhere. So how do we do it? Here is a bit of the email that I am replying to. Hi, Philip. I'm so confused about how to answer these questions, worried about doing something wrong. Here are the two questions. The first one here is got to do with a preference share, and the second one has a share that we need to value that will grow at infinity. Thank you for reading my hysterical rant, old student. Oh dear, you're not hysterical at all. Don't worry, we're here to help. And really, these aren't difficult questions, so let me guide you through them. So the present value of this preference share is simply going to be the following formula, right? Present value is equal to the dividend divided through by the required rate of return. And we're told that the preference share rate of dividends is 10%, but the required rate is 7.2%. Okay, so that's pretty easy here. Because if I take 10% and multiply it by 500, well, that's pretty simple. $50. $50 is the dividend we'll get paid annually. We take that dividend of $50, divide through by 0.072, and I'll get out my calculator. 50 divided through by 0.072 gives me $649.44 repeating. So that would be 694.4, 44, because we're round down, don't we? Yep, that is the value of our share. Okie dokie, next one is how do we deal with this growth? So we have dividends per share of an ordinary share that for the next 2 years will issue $2 and $3 of dividends respectively. And then into the future, it will grow at 10% until infinity. Okay, so if we have a little present value timeline here, we have time zero, that's now, and in 1 year's time, we're going to get $2, and then in the next year, we're going to get $3, and then every year thereafter, it's going to grow by 10%, so that's $3.30, you know, just going on forever. Okay, so we need to take two sets of cash flows because we can find a way to get a present value for a share that grows infinitely. That's very similar to the formula that we had above here. So what we do is we grab the dividend, divide through by the required rate minus the rate of growth, G. That will take the $3 in infinitely, and it will give us back a value to the beginning of period 1. So it's period 1, period 2, period 3, 4, and so forth into the future. Okay? Now, this $2 here also needs to be pushed back. So the $2 goes $2 divide through by 1 plus R. All right, to the power of n. N is, of course, just 1 here, so we don't need to worry about that n. We can simply delete it in this question. Now, let us start off with the thing in red because that seems to be the more difficult one. The dividend here is going to be $3 and it's going to be divided by R minus G. R is a required rate of 15% minus 10% growth forever. Basically, it's divided by 0.5. So I get myself my calculator. 3 divided by 0.05 gets me to $60. So we know that the present value at time period 1 of all of the future cash flow rates is going to be equal to $60. So that $60 needs to be added to the $2 that we will get at the end of year 1. So that gives us $62 divided by 1 point required rate of return is 15%. Get out my calculator. Run calculator. $62 divided by 1.15 gets me to 53.91 cents. So that is $53.91. Happy days. Not so hard, yeah? Don't ever feel like you're hysterical or, find this stuff difficult. It's simply a case of trying to break it down as to when are the cash flows, draw yourself a little timeline, and then think, okay, are we pushing the money forward in time or backwards in time? Do we need a present value or future value? Finance really isn't much more than trying to shift values through time. Thanks very much for watching. All the best with your exams. Happy studies.